Hello everyone. So we are starting a series on mutual fund where we are going to start from a very basic level and we'll touch and we'll go up to the advanced level conceptually as well as practically. So let's begin. So if I give you a small activity, I just want you to imagine that today if I give you 1 lakh rupee as a gift, what would you do with that money? Means I really want you to pause this video and just imagine this concept that where would you invest this money or spend this money? Means it's all yours, right? Now I want you to think that whether you go out for a party with friends, or you'll invest this money in upskilling, or you will go out and keep that money parked in just a saving account, or you'll start an FD for this, or else you may invest or you may put that money in PPF or a mutual fund or a stock market. So, or you may buy some gold. So there's so many ways to invest this money, right? Now, the main question that comes and that should come in your mind and that must have come in your mind, that sir, why we should invest this money? Means what is the purpose of investing the money? Means why can't I keep my money just in the bank account, in the saving account? There must be some reason behind that. Why everybody is advising to invest your money, right? So that is very, very important concept, that why we should be investing our money, right? So the right answer to this is, many people would say, sir, we want to grow our money, but how much? There must be some benchmark, right? Many people would say, sir, we get less interest rate in the bank and we get more interest rates in other schemes, right? Investment schemes. But what is the benchmark? What is that standard that we have to follow? You know, with whom we are competing with? So the right answer to this question is, we should invest our money to compete with inflation rate, guys. This is the benchmark. We have to defeat inflation, we have to beat inflation, and we are competing with this inflation only, right? So if I give you a practical explanation to this, right? I over here we have just not started mutual funds yet. We are just discussing that where we should invest our money and why we should invest our money. Why we should even start investing our money regardless of mutual funds, right? So the right answer to this is, we are competing with inflation. So we need to invest our money in whatsoever tool, including mutual funds, to beat this inflation, guys. Right? Let's give you a practical, example for this, so that this concept goes and sink in inside you. Just let's imagine, guys, you keep your money in bank account, right? Savings account. The approx interest rate you get on that is around 2%. It may touch 3% as well. But on an average, I'm taking it 2.5%, right? Guys, the inflation rate generally I'm taking for India, for example, it's around 5 to 6 to 7%, right? So we are taking it around 7% over here, right? So we are thinking and we will think that my money is growing at the rate of 2.5%, we are earning a lot of money. No, guys. In reality, this inflation is eating your money. The purchasing power of money is declining. Means in real terms, 2.5 minus 7 would be minus 4.5%. You will think that your money is growing at the rate of 2.5%, but in reality, it's not. This inflation is eating away your returns, right? Let's give you one more example over here. FD and PPF. Many people, they invest in FDs. Some people are smart enough, they go for PPF, right? Now, we are going to discuss this thing in the coming classes. What is PPF? But on an average, PPF and FD, you get returns around, it ranges from 6% to 7%, or maybe 7.1, 7.3, something like that. But we'll keep it around 6 to 7%. Now, again, when we invest in FD, we believe that our money is growing, right? But when we compete with this inflation, right? So in reality, if it is 7%, so 7 minus 7 would be 0. It means in reality, you may see that your money is growing in the bank, but in reality, it's not. Inflation is eating away the money which you have accumulated with the passage of time. I hope you are getting the point, right? Let me give you one more example over this, guys. You might have heard this thing. This concept is called as time value of money. Very important concept. As time passes by, the purchasing power of the money, it erodes, right? So what do you mean by inflation, sir? Why we are competing with this inflation? The rate at which the prices of the goods or services are increasing. It could be the prices of goods, it could be increasing, or it could be said in a different way, that the purchasing power of your currency, of the money, basically, that is depreciating. The both the statements are true. you know Either the commodity price is increasing, or I would say the purchasing power of money is decreasing. Let's give you an example for this. 10 years ago, means, when your grandfather or your grandparents, when they tell their stories with you, right, they may say, beta, in our time, we could have purchased 100 kg of rice with just 100 rupee, right? Means 1 kg rice for 1 rupee. See the purchasing power. 1 rupee could have purchased 1 kg of rice, right? But guys, today, just imagine, to buy a good quality rice, it may touch 40 rupee or 50 rupee. Just for 1 kg, I'm saying. I'm not even saying best basmati rice. A normal, household rice which we cook every day, it may touch 50, 60, 70 rupee per kg. So over here, what is happening? The price of rice is going up. We could say this way, or we can say in this way, that the purchasing power of that 1 rupee is going down. And after 20 years, just imagine, guys, with just this 100 rupee, you may not be able to buy 1 kg or 2 kg of rice. So it means, right, the purchasing power of the currency is going down with the time, right? So this is what I wanted to say over here. That was that wherever we are investing our money, we just need to first see what is the inflation rate at that point of time. For example, if the nowadays inflation rate in India is around 5%. So just always remember this thing and keep this thing in your mind. To make or to grow money in real terms, we need to earn interests which are more than this inflation rate. If it is 5, then it should be more than 5. It is 6, then interest rates or the returns on our investment should be more than 6. If it is 7, then it should be more than 7. If it is not, yes, you may see the numbers going up, your bank account increasing, but in the real terms, it's not. Let me give you one practical and real life example for this. Today, a good iPhone is costing you 1 lakh rupee for one iPhone. After 7 years, 2 lakh rupee may be required for that just one iPhone. 10 years back, when you used to go out with your family for dinner, for lunch in a restaurant, 1000 rupee was more than sufficient, right? For a whole family to eat good food. Today, 4-5,000 rupee is just goes away, because the cost of the food have gone up. It could be said this way, or the purchasing power of the money have gone down. Though you have 4,000 rupee today, but the purchasing power is not there, right? So that is why we should invest to beat inflation. We are competing with this. This is a giant who is eating your investments. So that is why, guys, if we invest in mutual funds, so mutual fund generally gives you return starting from 6% up to 15, sometime 18, sometime 20, 25% as well. But on an average, we are taking 15% return. So let's see how it works. So 15 minus 7 would be 8%. At least your money is growing at the rate of 8%. It's a good thing, right? Now let's see stocks. So stocks can give you sometimes negative returns as well, sometimes positive. So if they give you positive returns, we are taking on an average 20%. It can touch 30, 40, sometimes 100% as well, right? Now let's see. If we consider it as 20%, 20 minus 7 would be 13%. So see, it is at least positive, and over here your money would be growing in real terms, right? So if you ask, sir, did we beat inflation over here? Over here, yes, absolutely. So if somebody asks you this question, that why you are investing your money, so answer would be to beat this inflation, to increase my purchasing power in the next coming years. After 10, 50 years, the value of 1 lakh rupee just would be just like that, right? The thing is that the purchasing power of the money plays a very important role over here, and we are competing with inflation, and that's why we should invest, right? I hope you got the answer, guys. Now coming to the next slide. Now if somebody asks you this question, that not only in mutual funds but anywhere else, that why should you invest your money apart from bank saving account, the first answer is to beat inflation. I hope you got the point. Next answer would be compounding, guys. It's again very, very, very important. Now let's see how this compounding works practically in a calculator. Let's start the example again. If you invest 5 lakh rupee, and if you keep that 5 lakh rupee in a bank saving account for next 20 years at the rate of 2.1%, your money would grow up to 7 lakh. So this is the increment you are getting, 2,57,000 for next 20 years. I hope you got the point. So over here we are not beating the inflation yet. So purchasing power of this 7 lakh rupee after 20 years, just imagine, it would be just nothing. Now if we invest same in an FD at the rate of 6%, this money would have grown up to 16 lakh. So this 5 lakh after next 20 years would be 16 lakhs. Doing good. But in real terms, do you think your money is growing? No, because inflation rate could be much higher than 6% as well. I hope you're getting the point. Now, if I invest same 5 lakh rupee at the rate of 15%, let's see, the same amount would have grown to 81 lakh rupee. Just see, guys, this is what compounding is, right? More you will stay, more time horizon you are having in your hands, means more longer you'll stay in any investments. And if the interest rates are more than inflation rates, definitely your money will grow, and this money will convert into wealth. Wealth means good accumulated money. Now if you invest the same money in stock market, maybe at the rate of 20%, then the same money, same 5 lakh rupee would grow up to 1 crore 91 lakhs. Just imagine, we started from 2% bank saving account, it was just giving us 7 lakh rupee, and the same 5 lakh at the same for the same number of years, bit higher interest rate can give us around 2 crore rupee. Guys, I hope you got your answer. Means what I want to say over here, with time, if the time is long, right, interest rates are more than inflation, you can make good amount of wealth. You have to keep holding on for the long period of time. Longer the duration, better it is. And even if it goes more than 20 years, up to 25 years, just imagine, guys, this 5 lakh rupee will convert 4 crore 76,000 rupee. So if the time now keep increasing, even one year, every year will make one crore. See, in just 2 years, 5 crore, In next year it would be 6 crores. So every year I am making 1 crore rupee. Guys, this is the power of compounding over here. More the number of years you will stay and keep holding on, more money and more wealth. I'm using the term wealth over here, wealth you can accumulate. I hope this is clear, everybody. So, why we should invest? Regardless what wheresoever you are investing, it could be mutual funds, stock market, but we are beating inflation. We are competing with inflation. This is a benchmark which we have to defeat. Then comes, because we are investing our money, because we want to compound the money so that it converts into wealth. We are creating wealth over here, guys. I hope you are with me, everybody. Now, coming to the next slide. So, I told you so many things on inflation, right? Just imagine. So, these are the worldwide data on inflation, right? Just imagine if inflation rate goes up to 30%, inflation rate goes up to 40%, inflation rate goes up to 12% or more than that. So, guys, don't you think it is too high? Too high? Just imagine, guys. Let's take example of our neighboring country, Pakistan. Inflation rate is 30%, 30, right? Now let's come back to the previous slides once more. So over here, 30% inflation rate. It means saving account is giving us 2%, only 2%. Inflation is 30%. It means banking system will fail. People will lose trust on the banks because anyhow the purchasing power of the money have really eroded away. I hope you're with me, everybody. PPF and FDs and all the different saving instruments, they will also fail because anyhow they can't beat 30% inflation, right? Then comes mutual funds, not good, because if inflation rises so high, then guys, all the financial instruments, they can fail. So we always have to keep an eye on inflation. It means even if you have 1 crore rupee in a bank and inflation rate goes to 30%, 40%, and 1 crore rupee can't buy stuff, can't buy day to day commodities, guys. The money power erodes, the purchasing power of the money erodes, right? Yeah, few stocks can give you at least at par returns, right? It could be in real terms, it could be around 1%, 2%, because if the stocks are giving you 30, 40%, definitely they can. So I hope you are getting the point why we are investing our money. We are investing our money to beat inflation so that our money retains its purchasing power, right? This is the reason we should invest money. Earlier we'll start, it's better because compounding works better in long duration, right? Secondly,
It's 4 o'clock.
if interest rates are more than inflation, definitely we can create wealth, right? So if inflation goes really very high, guys, right, 30%, 40% like this, then what would happen? It will affect all the returns, all the investment tools, right? People will lose trust on all the financial instruments, on all the financial institutions as well, and financial instruments as well, because money can't buy stuff. So that's why at that point of time gold become very important, because gold is the only commodity that can hold it, that can hold its purchasing power. Means even if today 1 gram of gold can buy you few stuff, at that point of time 1 gram of gold can buy the similar amount of stuff, because purchasing power of gold never goes down, right? So at that point of time all the instruments goes down. Okay, let's proceed further. So over here one more thing that comes into play, that is, sir, if we are investing our money and we are competing with inflation, right? The same thing, can it work for the loans? Definitely yes. Means if I am taking loan and inflation rate goes very high, then I am the one who will be at the winning position. Why? Because if investors, when I am investing my money, I am competing with inflation. When I am taking loan, again I am competing with inflation. So over here, but one thing is contrary, one thing is opposite. So when I am investing, if inflation goes high, it's not good for me, right? But when I am taking a credit, sorry, when I am taking debt and I am taking a loan, right? Then if inflation goes high, it's good for me. It's opposite over here. So is taking debt a good idea when inflation is going high? Definitely. What is the difference? Let me show you in a tabular format. So guys, again, inflation versus loans. For example, guys, you have taken loan and you are paying interest of 14%, right? Inflation rate is 7%. So in real terms, in nominal terms, we will think, "Arey, we are paying 14% interest over here." But guys, in reality, you are not paying 14% because inflation is eating away this thing as well. So in reality, you are paying 14 minus 7, that is 7%, right? There is one more thing that is going to come, this line, last line, I'm just going to read. Let me complete the table first. So if the loan interest rate is around 10% and inflation is 7%, then 10 minus 7 is 3. It means you are paying, in real terms, 3% interest rate. It means when you are taking loan, you should expect and you should wish that inflation rate goes high. But when you are investing, you should invest in a way that you are always beating inflation, right? Let me complete this. If loan interest rate is 12% and inflation rate goes high, right? So 12 minus 12 is 0, guys. So in reality, yes, you are paying interest, but in reality, the purchasing power of money have gone down. In reality, you are not paying anything. If interest rate is 10% and inflation exceeds the interest rate, then guys, you are really not paying anything as such. It's minus 4. Plus, now let me give you one more example over there, one practical example, guys. If you take a loan to buy a home, right? If you want to buy a house and you took loan and this condition comes, right? You were paying 12% interest rate. Inflation also went high and it also touched 12%. So in reality, you paid money. I know you repaid the loan, right? But in reality, you didn't pay anything. Plus, the house which you purchased, the market value of that house, that home will also appreciate. The assets value will also appreciate. It means if you took 1 crore rupee loan, you repaid it, but the cost of the house, the market value of the house will become 2 crores after 10, 20, 30 years once you have started that loan. So you paid 1 crore, whose interest rate in reality you paid 0%. Yes, you paid all the EMIs, but still in reality you paid 0% because you were competing with the inflation. And along with that, the house which you had purchased with that loan, it also appreciated. So you were at double benefit. Your house appreciated, right? And the loan you paid, because of high inflation, it really in real terms you paid 0% interest rate. So you are in a better position when inflation goes high against when you have taken loan. That is why big businessmen, they try to negotiate with the banks to get the loans at lower interest rates. It's better for them, guys, because yes, everybody is competing, firstly. Secondly, even banks know these things. So banks always tend to charge you interest rates which are higher than inflation, and which they are expecting that inflation rate after 5, 10, 20 years would be around this. So they also know this thing. But now, being a smart investor, smart financial guy, you have to keep this in the mind, right? If inflation goes high, banks lose. It's not good for the bank, not for the government as well. But If inflation goes high, your investments also, it's the power of the purchasing power of the investment, the real growth of the investment also get affected. So we discussed inflation with respect to investments. We discussed inflation with respect to loans. I hope you got the point, everybody. Right? Okay. So, guys, we'll meet after some time. There's a small break, and after the break, we'll start a new topic. All right. Thank you.